Well, I know the U.S. stock market has been fighting its way back over the last couple of weeks, but it's still been a tough year for tech. And the sector overall is still struggling to win back Wall Street. Apple and Amazon's quarterly results seem to be a good example of that. The companies both highlighting some of the trade tensions and how that impacts their outlook. Let's talk about both Apple and Amazon now with Tom Forte. He's managing director and a senior consumer internet analyst at Maxim Group. Tom, always great to see you. Thanks for your time today.
Yes, thank you for having me on.
Okay, let's go through these two stories. We lump them together. These are such different businesses. But I'll start with Apple, where what's so interesting is, you got a company that has to navigate where they manufacture because of the trade tensions. But as a global provider of smartphones, with China being a key market as well, there's also the end demand story. What were some of your takeaways on what Apple had to say?
Yeah, so I think, when it comes to tariffs, we're trying to determine to what extent can a company share their burden with their suppliers? To what extent does the company have to take on the burden itself? In that regard, Apple suggested a $900 million tariff-related cost for the June quarter. And then to what extent that they can pass on the cost to consumers? We think Apple can raise prices, but they said at this point in time it's something they're considering, but not something they're moving forward with.
And so for the company itself, again, the idea of winning over Wall Street, every earnings season we see the various levers that a company can pull to try to appease the market. Right now, the shares are down about 4.5%. Was there anything the company said that would suggest there are some other things they can do as they navigate tariff uncertainty?
Yeah, so I would say that right now, Apple's clearly playing defense, not offense, and you could argue that they're treading water. So their strategy on a near-term basis is to assemble products in China for sale outside the United States, and then assemble products in India and Vietnam for sale into the United States. So what they're essentially trying to do is minimize the impact of tariffs by having products going to the U.S. sourced from lower tariff geographies, being India and Vietnam. It's unclear what the long-term strategy is. I think it's unrealistic to see Apple making iPhones in the US, but they did highlight that they are increasing their suppliers, or they're more lenient to US suppliers for components of the iPhone.
And, it's interesting, because this company has so much money and they have those levers they can pull as well, I already felt like we were kind of on the fence on what we thought of Apple as a sort of a stock market, a story that is growth, or a stock market story that is more value. But it does feel like the fact that Warren Buffett's Berkshire Hathaway was selling some of their Apple stock coming into this year, that people were increasingly concerned about the business story. Right now, as an analyst, are you basically on the fence? You're sort of kind of suggesting, it's not a stock you have to necessarily sell, but there's not compelling reasons to buy?
Absolutely. So I have a hold rating and a $201 target on Apple. And I did share Warren's views, where even before the tariffs, you had a stock trading at north of a 30-time PE multiple, and what success looked like was a mid-single-digit growth rate for earnings. So it was an expensive stock even before some of the tariff-related risk started playing out.
Okay, let's shift from the Apple story to the Amazon story. And, here's a company that I was saying earlier in the program, constantly chugging along when it comes to the ability to generate more sales, whether that's, e-commerce, the cloud, they've got that advertising business, but they too feel caught up in the tariff uncertainty. Comparatively, what would you say about the Amazon story? How do you feel about their business in this environment?
So the real risk to Amazon shares is that we have a recession, and then the faster growing, higher margin businesses, cloud computing and advertising, slow down. So I do think that they are balancing. 60% of the units sold on Amazon are not sold by Amazon. They're sold by sellers on Amazon. So they're balancing helping those sellers navigate tariffs and then also helping the consumers in the platform not face skyrocketing prices from tariffs. But I think as it pertains to the stock, the real risk is that AWS slows down or that advertising slows down. Advertising was quite good in the March quarter and seems to be heading well in the June quarter. AWS, their performance was a little less than expected. And I think when you saw the stellar numbers from Microsoft earlier this week on a relative basis, they did not look as good as Microsoft. And I think that's why you're seeing some pressure on Amazon shares today.
Just a final question on Amazon, because as they've been able to generate more profit from non-e-commerce over the last few years, that too is changing sort of the levers they have to appease investors. Is there going to be more of that, do you think, from Amazon, kind of the stuff that we started to see with Apple some time ago, being able to do more shareholder-friendly stuff from a company that just always seemed to be taking free cash flow and plowing it into just growing the business?
Yeah, so I think the difference between Andy Jassy leading Amazon and Jeff Bezos is Andy's found a way to generate free cash flow and have margin while investing in future initiatives. Whereas under Bezos's leadership, it seemed more like an either or. Either they were growing the business and having a negative impact on margin, or they were slowing down growth and then seeing margin expansion. Andy's found a way to adjust the costs and make other changes, really leaning into the services businesses, which he led at AWS before becoming CEO. And I think that's positioned it. I don't think they'll be initiating a dividend like Google did most recently, but I do think that they are able to show margin and free cash flow while still investing in the business.
Okay, Tom. Appreciate it as always. Great analysis. Tom Forte is a managing director with Maxim Group, joining us on both the Amazon and Apple story. And since both of those companies' outlooks could be impacted by trade uncertainty, we're going to bring you the latest details on what we're hearing out of China after the break. A suggestion that China possibly is willing to move towards a possible thaw with the U.S. in these trade talks. We'll get the latest details next.